Hello, I'm John A.G., and I want to begin with a moment that probably hasn't left your mind yet, even if you haven't fully named it. It's that quiet pause after something violent happens, when the noise fades faster than it should, and you realize the absence itself feels heavier than the event. Not relief, not clarity, just a strange awareness that whatever you thought was stable may have only been stable because it hadn't been tested like this before. Silver didn't just fall. It didn't unwind slowly or correct in a way that invites rational explanations. It snapped. In a single trading session, decades of assumed behavior were compressed into hours, erasing nearly a third of its paper value and dragging gold down with it. Trillions of dollars disappeared so quickly that the scale almost stopped registering as real. But if price were the most important part of this story, it would already be over. What makes this moment unsettling is what followed the collapse, or more precisely, what didn't. In every major market shock, there is usually a chorus. Banks speak, strategists reassure. Research desks release explanations that frame the damage as understandable, temporary, or even healthy. The words matter less than the presence of them. Communication itself stabilizes confidence. This time, that chorus never arrived. The largest institutions in the precious metals market, the ones with the deepest visibility into leverage, flows, and counterparty risk, went completely quiet. Silence like that is not neutral. In financial systems, silence is a position. It changes how fear spreads, how assumptions form, and how people interpret what comes next. When institutions that normally explain everything suddenly explain nothing, it introduces a different kind of volatility, psychological volatility. People are left alone with price, and price without context is destabilizing. The natural instinct is to look at a crash and assume something must be fundamentally wrong with the asset. That instinct offers comfort because it suggests the market has discovered a truth. But comfort can be misleading. In heavily leveraged markets, price often reflects mechanical stress long before it reflects reality. Margin rules, not value judgments, determine survival in those moments. When margin requirements rise abruptly, positions that were sound under yesterday's rules become untenable under today's. Selling becomes compulsory. Conviction no longer matters. Every forced sale pushes price lower, triggering more margin calls, which force more selling. This is not panic in the emotional sense, it is liquidation in the mathematical sense. And once it starts, it accelerates until something breaks or the weakest participants are removed. This is why violent crashes often say more about structure than sentiment. They reveal where leverage was hiding, who depended on stability, and who had the liquidity to wait. They also reveal something else that rarely gets discussed in real time. Crashes create opportunity for those who are prepared for them, especially those who were under pressure before they occurred. Silver's rapid rise into previously unimaginable price territory placed enormous strain on anyone positioned against it. Paper losses grow as prices rise, but those losses remain unrealized until positions are closed. A sudden collapse changes that equation. Losses shrink. Exposure can be reduced, and if you are large enough, you can do it quietly, while others are forced to react. This is where the rebound becomes important. After the initial collapse, prices jumped sharply, offering a moment of relief. That relief didn't last. The rebound failed, and selling resumed with renewed force. This pattern is not random. It is typical of forced liquidation environments, where buying appears once selling pressure pauses, only to disappear again when margin stress resumes. Hope flickers, then vanishes. For participants caught inside that volatility, time compresses. Decisions that should be made with distance are made under pressure. Horizons shrink from years to days, from days to minutes. This psychological compression transfers advantage to those who are not subject to it, those who can remain patient while others cannot. And again, silence matters. Institutions that understand this dynamic have no incentive to calm markets while they are still repositioning. Speaking too early risks moving prices against themselves. Speaking too late risks revealing what they've already done. Silence buys flexibility. History has a habit of repeating this pattern. Before previous systemic breaks, public confidence eroded quietly, not because of headlines, but because the people who knew most said least. Silence preceded repricing, restructurings, and failures that later seemed obvious, but were invisible at the time. What makes the current moment more complex is the divergence emerging beneath the surface. While paper prices collapsed and volatility exploded, reports from physical markets began to tell a different story. Premiums rose instead of falling. Availability tightened instead of expanding. Dealers hesitated, not because demand disappeared, but because supply felt uncertain. This divergence is deeply uncomfortable because it challenges a core assumption most people carry without realizing it, the assumption that the price you see on a screen reflects reality. In normal conditions, that assumption mostly holds. Under stress, it can fail. Futures markets can purge leverage instantly. Physical markets cannot create metal instantly. When those two realities collide, pressure builds somewhere unseen. This is not a theoretical concern. Historically, Prolonged disconnects between paper and physical markets resolve in one of two ways. Either paper prices adjust upward to reflect physical scarcity, or physical availability contracts until paper promises are questioned. Both outcomes undermine confidence, and neither happens gradually once trust begins to erode. Banks understand this better than anyone. They have lived through moments where liquidity vanished overnight, not because assets disappeared, but because trust did. That memory informs how they behave now. Silence allows them to observe reactions without anchoring expectations. It allows them to move without signaling intent. At this stage, the most important developments rarely appear on price charts. They show up in behavior, in inventory movements, in settlement terms, in how willing dealers are to commit. These signals are subtle, but they accumulate meaning. They hint at stresses that have not yet surfaced publicly. The mistake many people make is assuming that a crash completes a story. Markets rarely offer that kind of closure. More often, the first violent move is a transition, not an ending. It clears pressure, redistributes risk, and resets narratives, setting the stage for something that looks unrelated but isn't. If this collapse was driven primarily by structural stress rather than a collapse in underlying demand, then the most important question is not why prices fell, but why the system needed them to fall so violently at this moment. That question does not get answered by watching headlines. It gets answered by watching incentives, behavior, and silence, because silence in markets like this is never empty. It is filled with decisions being made out of view, and once those decisions are complete, what follows rarely feels like a continuation. It feels like a shift. What makes the period after a collapse like this especially deceptive is how quickly the mind reaches for closure. Once the initial shock passes, there is a powerful desire to believe the danger has already expressed itself, that whatever needed to break has done so. That belief offers psychological relief, but markets are not designed to resolve stress in a single motion. More often, the first rupture simply relocates pressure from obvious places to hidden ones. This is where misunderstanding begins. Most people assume markets are driven by opinions, optimism, fear, or collective belief. Those things matter, but only at the surface. Beneath them sit incentives, rules, and constraints. When incentives change abruptly, behavior follows instantly, regardless of belief. The recent crash was not a mass change of heart about silver. It was a sudden reordering of what positions were survivable under new conditions. Forced liquidations do not discriminate between strong hands and weak ones. They remove whoever lacks liquidity at the wrong moment. Once that process runs its course, the market does not become healthy. It becomes quieter, and quiet markets are often mistaken for stable ones. The survivors of a liquidation event are not evenly distributed. Those who were overleveraged are gone. Those who had cash gain optionality. Those who understood the structure gain leverage over narrative as well as price. This is when silence becomes most useful. Speaking would invite scrutiny. Remaining silent allows positioning to continue without interference. At the same time, something subtle but important happens to confidence. Not panic, but recalibration. Participants who believed prices could only move within familiar ranges are forced to reconsider. That reconsideration changes future behavior. Risk tolerance declines. Hedging increases. Commitments shorten. None of this requires a crisis headline. It unfolds quietly, altering the market's internal rhythm. This is where the divergence between paper and physical markets becomes more than an anomaly. Paper markets are designed for speed. Contracts can be created, traded, and extinguished almost instantly. Physical markets are designed for delivery. They move at the pace of production, logistics, and trust. When stress hits, paper markets adjust immediately. Physical markets absorb stress slowly until they cannot. Rising physical premiums during a paper price collapse are not a contradiction. They are a warning. They indicate that while financial exposure is being purged, real-world supply is not expanding. In some cases, it is contracting as producers hesitate and dealers become cautious. This creates a mismatch that cannot persist indefinitely. The uncomfortable implication is that the price most people anchor to may be the least informative signal in the system. Screens show transactions between contracts. They do not show willingness to deliver, nor do they show the confidence behind those promises. When that confidence weakens, the system compensates by changing behavior, not by issuing announcements. Banks are acutely aware of this. They understand that markets are held together as much by expectation as by inventory. Once expectation shifts, restoring it is difficult. This is why they are careful about when and how they communicate during stress. Silence prevents anchoring. It allows flexibility. It buys time. Another layer of fragility emerges when counterparty exposure is reconsidered. In calm periods, counterparties are abstractions. During stress, they become specific. Who is on the other side of this trade? What happens if settlement is delayed? What protections actually apply? These questions are not new, but they are often ignored until volatility forces attention onto them. Paper instruments rely on chains of obligation. Each link assumes the next will perform. Under normal conditions, that assumption holds. Under extreme repricing, it becomes conditional. Clauses that once seemed theoretical suddenly matter. Delivery windows, substitution rights, settlement options all move from fine print to focus. This is how stress migrates. It leaves price and enters process. It leaves screens and enters negotiations. It leaves public view and enters private risk meetings. By the time outcomes appear publicly, they are often the result of decisions made quietly weeks earlier. History does not repeat perfectly, but mechanisms recur. Past crises did not unfold because assets suddenly lost intrinsic value. They unfolded because the structures built around those assets could not tolerate rapid changes in incentive. When leverage unwound, damage traveled through channels that were previously invisible. The current environment shares that vulnerability, amplified by speed. Markets move faster now, leverage adjusts faster, narratives form faster. Transparency has not kept pace. When something breaks, explanation follows damage, not the other way around. What happens next will not be driven by fear, even if fear dominates headlines. It will be driven by how institutions interpret the new incentive landscape. Whether they seek to restore stability or exploit instability. Whether they reduce exposure or redeploy it elsewhere. Silence suggests deliberation, not confusion. For those watching from outside the system, the challenge is resisting the urge to treat every price move as a conclusion. Price is a symptom, not a diagnosis. Volume, volatility, and behavior together tell a fuller story, and even then, certainty remains elusive. The most dangerous assumption at this stage is that normal conditions have returned, that the system has absorbed the shock and resumed equilibrium. In leveraged markets, equilibrium is often temporary, a pause between adjustments rather than a resolution. The unresolved question is not whether volatility will return, but where it will surface next. Policy responses may shift incentives again. Delivery constraints may tighten quietly. Currency dynamics may reassert themselves. Each path carries different implications, but all share one trait. They tend to surprise those who believe the last move completed the story. This is why the current relative calm should not be mistaken for safety. It may simply be the interval where positions are reassessed and narratives rewritten, a period where silence fills the space that explanation normally occupies. And if that is the case, then the next development will feel less like continuation and more like reframing, not just of price, but of what this market represents and how it functions. The unsettling possibility is that by the time this reframing becomes obvious, the ability to respond deliberately will already be gone. What follows a rupture like this is rarely dramatic at first. There is no immediate headline that announces the deeper shift. Instead, the system begins to behave differently in small, almost invisible ways. Participants become more cautious without saying so. Liquidity becomes more selective. Commitments shorten. Trust is no longer assumed by default. It is evaluated, transaction by transaction. These changes do not feel like a crisis. They feel like prudence. But taken together, they quietly alter how the market functions. This is how confidence actually fails, not in a single collapse, but through countless small decisions that all lean towards self-protection. A dealer adjusts terms. A lender increases requirements. A trader reduces size. None of these actions require public justification. They require only memory of how quickly assumptions were punished when stress arrived. Precious metals markets are especially sensitive to this process because they rely so heavily on layered promises. Promises to deliver metal. Promises to settle contracts. Promises that paper exposure can always be converted into something real if needed. Most of the time, these promises coexist comfortably because they are never all tested at once. Stress tests them simultaneously. When that happens, the system does not immediately break. It tightens. It becomes less forgiving. Optionality becomes valuable. Certainty becomes expensive. Participants who once operated on trust begin operating on verification. This transition is subtle, but it changes everything about how risk is priced. The instinct of institutions in this phase is not to reassure, but to observe, to see who blinks, to see where stress reappears. Silence is useful here, because words anchor expectations. And anchoring expectations too early limits flexibility. By saying nothing, institutions allow the system to reveal its weak points organically. This is also the stage where policy influence begins to matter, even if it is not visible yet. Policymakers do not respond to price alone. They respond to disorder, especially when disorder threatens to spill into adjacent systems. Extreme volatility signals disorder. Divergences between paper and physical markets signal disorder. These signals may not trigger immediate action, but they enter the decision framework. Markets begin to price the possibility of intervention long before intervention occurs. That pricing alters behavior. If participants believe support may arrive, they act differently than if they believe restraint will prevail. Expectations shape positioning, and positioning shapes outcomes. This feedback loop operates quietly. outside the view of most observers. At the same time, supply dynamics continue to evolve independently of financial stress. Mining projects do not accelerate because volatility increases. Investment decisions made years ago determine today's output. When prices collapse suddenly, producers often become cautious rather than aggressive. Forward selling slows. Capital allocation tightens. Supply responses lag even further behind demand signals. This lag creates asymmetry. When demand eventually stabilizes or returns, supply cannot respond immediately. Scarcity emerges not because demand explodes, but because supply hesitates. This is one of the least intuitive aspects of commodity markets, and one of the most repeatedly misunderstood. People expect cause and effect to be synchronized. In reality, they are separated by time. Narratives struggle in this environment because narratives prefer clean conclusions. Some will declare the crash a final top, proof that optimism was misplaced. Others will frame it as a cleansing event, a necessary purge before a stronger advance. Both narratives offer certainty, and certainty is comforting. Neither accounts fully for the complexity of what has changed. What has changed is not simply price, it is behavior, it is memory. It is the willingness to trust structures that were previously taken for granted. Once that willingness erodes, it does not return quickly. Systems remember stress longer than participants expect. For anyone trying to understand what comes next, prediction is less useful than reframing. Instead of asking where silver or gold prices will be next week or next month, ask what assumptions were exposed, which beliefs were punished, which structures revealed fragility. These questions do not yield forecasts, but they sharpen perception. Sharpened perception changes how future information is processed. When you recognize that recent price action was driven by structure rather than sentiment, you stop interpreting every move as a verdict on value. You begin to see movements as expressions of constraint, incentive, and positioning. That perspective does not eliminate uncertainty, but it makes it more navigable. The silence that followed this crash fits into that framework. It does not guarantee a single outcome. It signals unresolved tension. Decisions still in progress, positions still being adjusted. Silence creates space for those processes to complete without interference. Eventually, communication resumes. It always does. When it does, what matters will not only be what is said, but what is emphasized and what is quietly avoided. Language reveals priorities. It hints at where pressure remains and where confidence has returned. By the time that communication arrives, however, the most important shifts may already have occurred. Risk will have been redistributed. Terms will have tightened. Behavior will have changed. These shifts are difficult to reverse because they are rooted in experience, not opinion. This is why the idea of a simple return to normal is misleading. Normal was built on conditions that no longer exist. Leverage profiles have changed. Trust has been tested. Memory has been refreshed. Even if prices stabilize, the system carries scars. For some, this realization will feel unsettling. It removes the comfort of clear answers and tidy endings. For others, it will feel clarifying. It reframes volatility not as chaos, but as information. A message about where stress lives and how incentives truly operate. The real question is whether that message is heard. Whether participants adjust their mental models or cling to old frameworks because they are familiar. History suggests many choose familiarity, which is why similar patterns recur under different names. As this chapter closes, it may be worth resisting the urge to resolve uncertainty too quickly. Uncertainty is not the enemy. False certainty is. Markets tend to punish certainty most aggressively at turning points, because turning points exist precisely where certainty breaks. What comes next may feel disconnected from what just happened. That is often how transitions appear. The seeds of the next move are planted during moments that seem like pauses rather than decisions. By the time the connection becomes obvious, it is no longer actionable. So the most unsettling question is not how high prices might go or how low they might fall. The deeper question is whether the confidence that once underpinned this market can be rebuilt without confronting what this episode quietly exposed, or whether the silence that followed was not a pause at all, but the sound of assumptions breaking in a way that cannot be fully repaired.